there, folks, and welcome into today's video. So, going to react to a couple of videos here. One, Funstrat's Tom Lee, everybody's favorite bull, admits he's been too bullish on stocks. So I'm interested to hear that. And I thought we'd react to this one. I'm staying long Berkshire Hathaway. It's a tank, says Josh Brown, okay? So first off, before we get into those reactions there, I want to take a look at the market here. And first thing we're looking at here is a put-call ratio. Kind of spiking down a bit here today. Basically, the way to think about this is if the put-call ratio goes above 1, that usually means investors are very bearish on the market. They're betting against the market, right? A put option is essentially a bet that stocks are going to go down. Below a 0.75 usually means investors are bullish on the market. So obviously, a lot of that bullish activity has left the market here in 2022. It's just not there, right? If we go back a year ago, there was a lot of bullish activity. I mean, look at how much you're below 0.75 for this entire time period. But recently, yeah, we've either been neutral or actually spiking above, meaning investors are very, very bearish. So I thought that was an interesting point to start here. Oil. Oh my gosh, okay? Oil has been spiking down, and I mean, oil now is down about 25% in a matter of a few days. I mean, that's an insane move. Let's see from the peak. I don't know why it doesn't quite calculate from the peak properly there, but we're talking like a 25%ish type downward move for oil now since it peaked out. Oil trading about $95 right now. And here's the most amazing thing about this, right? Here's the most amazing thing is so many, I would call them very intelligent, either traders or investors, really thought oil was going to continue to spike higher. If we went back a week ago in time and I asked pretty much every intelligent investor or trader out there, do you think oil is more likely, this is back when oil was, spiking to 125, 130. If I told them, do you think it's more likely that oil is 140 or 150 by this time next week or $95? I almost guarantee you 100% would say, I think it's going to 140, 150 by next week. 95, yeah, good luck getting it down there. And here we are in this moment in time where oil has now spiked down to 95 and 25%ish type drop from just where it was literally like 6 days ago. So that's a market for you, and that's why you can't get too, caught up into thinking you might be right in something short term, because it's very hard to be right short term on these things, even when you think you got the insight there, right? Look at the Hang Seng Index. It was down another 5.7% last night. So basically what's going on is now China is facing potential lockdowns again. Rona scare again. I know it's like, what? That's still like a thing? Yes, it is still a thing. And look at the Hang Seng Index. Since February, I mean, just a drop, 23% or so there. About a 25% drop on a 1 month for the Hang Seng Index. Just vicious. I mean, especially that last month, almost a 25% drop. And when it comes to Chinese stocks, what's it got going for them? If they're locking everything down again, it's like, okay. It seems like a never-ending kind of cycle over there. VIX is spiking down here. We're still extremely elevated, trading around a 30 on the VIX. When you're trading around 30, that's high, okay? Now, it's not insane high like we were, about a week ago when we were trading at VIX, 36, 37. That got to insane levels, right? Insane levels when you start spiking up there. So, VIX is coming down now, not as much volatility in the market. The DAX is still kind of not doing too well. The NASDAQ today is having a great day for the NASDAQ. Obviously, on a 1 month, it's no bueno. It's no bueno, or a 3 month for the NASDAQ, either one. But on a 1 day, yeah, great day for the NASDAQ. NASDAQ's up 2.8% here today. So great for the NASDAQ. S&P 500's up 2%. If I look at some stocks that, I own, I got a little bit of money in Beyond Meat. That's having a good day. 8% move there. Tattoo Chef's having a good day. 6% there for the chef. A bit of a comeback. Tesla's having a really good day today. 4.6% there for good old Tesla. My Tesla. If we go ahead, I got different watch lists. Let's check out Big Tech today. Wow, Big Tech's having a great day today. Look at these moves for Big Tech. Nvidia 7.7%, AMD about a 7% move, Tesla 4.6%. Amazing's on a 4% move. Netflix 3.8%. Microsoft, oh man, it's a great day for big tech. A lot of recovery when it comes to big tech stocks there. Ooh, let's pull up everybody's favorite, my travel watch list. Let's see how that's doing. I would assume, I haven't looked at this yet, but I would assume based upon where the market's at today and based upon the fact that oil's spiking down, I would assume all the travel stocks are moving up big. Okay, let's just take a look. And yeah, definitely a lot of big upward moves there. UAL, United Airlines, 8%. American Airlines, 8.4%. Hawaiian Airlines, 5%. Southwest Airlines, over 4% there. Win about 3.7%. Win's kind of held back, unfortunately, because of the China shutdowns again. I mean, that's just devastating for Win's business. It's like, is Macau ever going to be able to really open back up again? And that's like a big question. It's like if there's just a new variant and a new variant and a new variant, I guess they'll just keep Macau closed for all of eternity. It's insane, man. So that's just China's stance on that, and it's just like you can't do anything about it. And so it's frustrating. I think as a shareholder, I have Win stock in my my dividends only account, and it's just frustrating. There's nothing they can do if China wants to keep Macau pretty much closed. They're going to do that, right? But at the end of the day, when it comes to a lot of these travel stocks, if oil spikes down, that's great news. That's great news for a lot of these travel plays, right? Great news there. Okay. If we go ahead and pull up my stocks I'm watching, but I don't own yet watch list here. Let's see what we got here. Yeah, it's definitely some big bounce back moves. GoodRx, about almost a 12% move there. Stitch Fix, 8%. Shopify, 8.8%. Square, 8%. Lemonade, 8%. Teladoc, big move here today, 7%. I think the most important thing to remember when it comes to a lot of these stocks, though, is remember how much they're down. And so a lot of times if some of these stocks start to bounce back, let's say the market starts to bottom, something like that, a lot of people, get a little gun shy and they're like, well, it had a huge day today. And it's like, at the same time, remember how much these stocks are down. And, like for instance, the Stitch Fix, yeah, it's having a great day today, right? But you pull up a 1 year on Stitch Fix, 83% down. You know what I mean? Like, and you could go through a ton of stocks. Shopify in a 1 year is down 51%, but even worse, if you pull up like a 3 month for Shopify, 57% in 3 months. So a lot of these stocks have gotten absolutely devastated. I mean, you look at something like a Teladoc on a 1 year, Teladoc 73% down, and so yeah. They're having a good day today, but it's still like for a lot of these stocks, people would consider them joke prices. Palantir at 10, yeah, it's up 1.8%, but that's like nothing for that stock, right? So I just think that's some kind of food for thought there with that, okay? All right, guys, so let's hear what Tom Lee has to say here, and then we'll listen to what Josh Brown has to say about Berkshire. React to these. Hope you guys enjoyed it. Always much love. Hope you, let me know if you enjoy a format like this. Is probably the closest thing you'll ever get to me doing a market close type thing, okay? So make sure you subscribe to the channel also and get some free stocks from Moo. Pin comment down there. Do you like free money? Do you like free money? Do you like free stocks? Check out the pin comment down there. Alrighty, guys, let's get into this.
Than most strategists, and one who has argued after a treacherous start to 2022 that stocks can still have a good year. Fundstrat's Tom Lee is...
Tom Lee, he called for a quote-unquote violent rally in February. And there was no violent rally in February, obviously.
Now, welcome back. It's good to see you.
Good to see you, Scott and crew.
Will you admit that you've been too bullish on stocks?
Yes. I'd say that our base case...
I like the way he says, yes. I like that. I like that.
Yes. I'd say that our base case for this first half of this year was stocks would be treacherous. But it's been far worse than we expected. I mean, if I look back at first half 2022, it looks like, as Josh is describing, the market is really bent. I mean, especially economic expectations towards a recession. That was not something we expected. So it's been a far deeper correction than we thought possible, but I don't think the contours of the rest of the year change that much. So I think what's been sort of created as big headwinds, the decision point is going to be if we avoid recession. And I think for a lot of reasons, I don't think the U.S. is actually going to be breaking into a contraction.
I feel like the bullish goalposts, though, have moved.
So just to be clear what he's saying, he's basically saying that he still doesn't expect a recession, and he still expects a strong back half of the year, second half, meaning basically, midsummer and after he's still expecting a strong second half of the year. So
we still want to act as though nothing has really changed for the remainder of the year. I've got a Fed that's still going to be aggressive in trying to get a handle.
And to be fair, going into this year, Tom Lee, he basically said the first half of the year would be treacherous, meaning it would be a lot of, shaking around. It would be a lot of, some downward moves, but basically kind of saying like he expected the first half of the year not to really do much. And so to be fair, he's kind of right on that. It's just he's probably been too bullish along the way. And by trying to say things like there was going to be a violent rally in February that never obviously came, I think that's where he's gotten himself kind of into some trouble and maybe some credibility type stuff.
Inflation.
There.
I've got earnings which are already trending lower, which are undeniably going to be trending lower. Economy looks like it's slowing. How do I deal with all of that and suggest that stocks can still rise in that kind of an environment? Maybe they can, maybe you'll be right, but how?
It's part of its perspective. I mean, oil's surged, but at $100 a barrel, that's where we were 2014, for almost 4 or 5 years. And today on a price per barrel, if you're paying $90 for oil, you're still paying like close to $200 for Diet Coke and $300 for bottled water. So oil's still pretty cheap, and as a burden, it's quite small. And in terms of the Fed the Fed not having a put because they have to tighten, I think it's really going to depend on the.
Did I hear a lady laughing?
$300 for bottled water, so oil's still pretty cheap, and as a burden, it's quite small. And in terms of the Fed the Fed not having a put because they have to tighten, I think it's really going to depend on the path of not only the war but supply chain glitches. And I know it's a very difficult sort of period for the Fed to navigate, but I think everyone's consensus is making a view the Fed's turned hawkish, and I don't think that's true. I think they're trying to find appropriate policy, but I do think consensus thinks they're so far behind they have to tighten to create a recession. So that's a really second sort of point of distinction. And the third is I think there's been a lot of selling recently. Of course, markets can fall for any reason, but I think we're forgetting that these sanctions against oligarchs, that's close to $300 billion of externally managed money that a lot of hedge funds now have to either freeze or redeem. And that's putting a lot of selling pressure on markets, and that's going to abate. So I think a lot of things that we're...
That's a great point. That's a great point. I don't know if you guys caught that there. Not a small amount.
That a lot of hedge funds now have to either freeze. And the third is I think there's been a lot of selling recently. Of course, markets can fall for any reason, but I think we're forgetting that these sanctions against oligarchs, that's close to $300 billion of externally managed money that a lot of hedge funds now have to either freeze or redeem. And that's putting a lot of selling pressure on markets, and that's going to abate. So I think a lot of things that we're seeing that look like amplified downside pressure could be transitory.
That's a great point he brings out there. $300 billion from Russian oligarchs that money is controlled by hedge funds and things like that. That's a huge amount. And you think about it, and right around that time, markets all shook down, right? And that's one of those factors. I don't know if that money's coming back anytime soon. That's the kind of bad news for the market, at least, right? But from a perspective of kind of putting all these pieces together, it honestly makes sense, right? If you're a hedge fund and you can't have that money invested, you have to potentially sell those stocks, right? I don't even know, it gets complicated. I don't even know if they allow you to hold just the money. A lot of times they probably make you either have to sell it, or if you're a hedge fund manager, you might be thinking, I'll just sell this. Because what if we get into some situation that it looks like we are still holding money, and then next thing you know, we got some sort of federal charges against us or something, and that could get really, really serious, right? And so that honestly makes a lot of sense, and that's a perspective I appreciate, because that's the type of stuff you're not even going to hear most folks even talk about, which I think is a really, really important subject. Really, really important subject, okay? All right, let's listen to this next one here. I'm staying long Berkshire Hathaway. It's a tank, says Josh Brown, and I used to own Berkshire Hathaway stock, I don't know, what was that, a year and a half ago, when the market was getting really, really frothy. I definitely bought some Berkshire, and Berkshire Hathaway, probably the most diversified business you could possibly own. I mean, you're talking about a company that owns, everything from like Geico to Fruit of the Loom to Dairy Queen to furniture stores, like, railroads, just an insanely diversified company. And then their positions as far as, stock positions, they own like, oh my gosh, it's probably $100 billion plus dollars, if not a couple $100 billion in Apple stock. They have, fortunes of money invested into the big banks, credit card companies, things like that. And so you're talking about Berkshire Hathaway, you're talking about probably the most, the most diversified business model in the world, in my opinion. And, the closest thing you could get to pretty much a stock that represents the S&P 500. It's incredible. Okay.
Hathaway Class A shares topping $500,000 yesterday for the first time. Shares up 10% on the year. You probably know Josh Brown owns Berkshire B shares, and he has made it his final trade on numerous occasions.
Berkshire B shares. It's for the poor people. You got to own the A shares. Come on, man.
What do you do with Berkshire now? Give me something on this stock.
So I'm staying long. I'm a long-term investor here. This thing's been an absolute tank. It really was not the place to be in 2020 and 2021, for most of that year at least, as people prioritized other things like total addressable market and the quality of their memesmanship, which was lacking. But this year is a return to sanity, and Berkshire is outperforming 28 out of 30 Dow Jones Industrial Average components.
Wow. Outperforming 28 of the 30 Dow components. Interesting. That's beast.
It looks better than almost everything in the S&P, other than a handful of materials and industrial stocks. And I think that can continue given the mix of where they get their book value, their revenue, what this company consists of. We know that insurance premiums are A, mostly recession-proof, and B, a good inflation hedge. As insurance contracts run off, people don't say, oh, the price is going to be higher, I'm not going to renew. Obviously, the railroad has been incredible this year, obviously, with all the commodity demand. And then you think about all the cash. It's $140 billion. God forbid we have a recession or a worsening economic environment. That's a ton of flexibility for Buffett to do what he's done best over the years. And then you look at Apple, and you think about that, the importance of that position, the fact that Apple paid Berkshire $800 billion in dividend, $800 million in dividends last year. This is an enormous investment that they've made. It's paying off. And now it looks like they're building their next position, which is Oxy, which is going to be a huge investment for them if natural gas prices stay elevated. So many, many, many levers to pull, many ways to win. I think the stock should be okay for the balance of the year. I'm sticking with it.
All right, so I want to take a moment here. I'm going to pull you guys up Berkshire Hathaway's stock portfolio right now. We're going to look over that, and I'm going to talk about some of the kind of risks to Berkshire here for a moment. All right, so this is their position sizing as far as the stocks they hold, Warren Buffett and Berkshire holds here, essentially. And this was as of their latest kind of release and whatnot. So first thing to look at here is Apple represents about 43% of the portfolio. So for the good and the bad news with this is Apple's a beast, and so that's great, right? The bad news is if Apple stock has any trouble, which recently Apple stock has had some trouble. I think it's down 14%-ish year to date, something roughly around there, okay? I know it's more than 10%. We can actually pull it up here. So right on, yes, Apple's down over 14% so far year to date, about 15%, right? So the bad news for Berkshire now is they're going to essentially likely, especially if the stock continues to downtrend, they're going to take losses on that over the next 3 months from an accounting standpoint, which is going to make them look at least like their EPS is not nearly as good as it is. I think it's kind of silly the way you have to record these things, and if Apple stock goes up a bunch, they technically all of a sudden it makes their EPS look a lot better than it really is. I don't think that's the right way of doing it, but it's not Berkshire's decision, it's not Warren Buffett's decision. It's the way they changed accounting standards, which I think is a bad decision in the end, because ultimately, Berkshire is not taking a gain or a loss on Apple stock until they sell it, right? And so I think it's kind of silly, but at the end of the day, if Apple stock is dropping, it's going to make Berkshire's EPS look way worse. come this upcoming quarter, essentially, right? Never mind if it continues to drop. Bank of America is their second biggest holding. That makes up about 13%. So I think it's interesting. If you look at what Buffett, the way he invests in Berkshire invests, I mean, you're talking about 56% plus of the portfolio weight is in the top two positions, right? Now, obviously, you can say, well, Berkshire is a very diversified business because they own a ton of businesses outright and things like that, right? Perfectly fair. But when they run stocks, they don't diversify very much, man. If you asked, a financial advisor or something like that, like, hey, I'm thinking about putting all my money in two stocks, or 56% of my portfolio in two stocks, they'd be like, what? You're crazy, man. Then you add up, 56. Now we're at, something like 64. Now we're at like 71, 72. So roughly 71, 72% of their entire stock portfolios in these three stocks: Coca-Cola, American Express, Bank of America, and Apple, which is kind of insane to think about, right? I mean, that's even more aggressive than I run my stock portfolio. I don't even think I have 72% or whatever of my portfolio size in my top four positions, which is crazy. With Warren Buffett runs his portfolios even more aggressively than Jeremy Lefebvre. Like, who would have thought that, right? Kraft Heinz at 3.8%, and then it kind of goes down from there. So when it comes to Berkshire Hathaway, at least on the stock side, these four stocks make or break Berkshire Hathaway. These four stocks make or break it, but specifically Apple. And so if Apple has any sort of trouble over the next few years growing their business or commanding a higher valuation, which Apple's valuation has gotten pushed recently, right? That's where you could kind of get into some trouble, at least in the short term, when it comes to Berkshire's stock price. And if we pull up, if we look at Apple over time, what you're going to see, so I got market cap here, price to sales ratio, PE ratio. What you're going to see is, let's specifically watch the PE. So Apple today trades at a 25.7 PE. But what you're going to find is Apple always trade at a far cheaper PE, 16, 17, 18, 16, 17, 18, 15, 20, 14, 12. This is over the last 5 years. 14, 15, 17, 19, 21, 23, 25. It always traded at very low PEs until basically about the past year or two. And then all of a sudden it started trading at these, 20s and 30s. When it used to be, like 10, 12, 14, 16, 18 type range, right? Look at right here as a P of 12. If you look at right here, P of about 14, right? If you look right here, you're at a PE of 15, a PE of 17. So it's interesting. Apple just trades at a richer valuation than it ever has. So I think that's something to think about. So anyways, guys, hope you enjoyed this video. Much love. Thanks for joining me. Make sure to subscribe to the channel and make sure you get your free stocks from Moo. Check out pinned comment down there. Much love and have a great day.